Hi, Robert A. Bonavito, CPA, New Jersey forensic accountant. Today we're going to discuss stock and crypto wash sale rules. Now, if you enjoyed this video, I really would appreciate if you could smash the like button because it does help a lot. Now, when you want to turn unrealized capital losses into realized capital losses without triggering the IRS Wash Rule, what do? And this is particularly important now because what's happening out there, at least in the year we're doing this video, stock market's down quite a bit and people have substantial losses. And this is going to help you realize those losses because in order to realize these losses, there are certain IRS rules you need to be aware of. Now, the purpose of the Wash Law was made by Congress in 1930 in order to stop taxpayers from selling a stock at a loss and buying it back the same day, because Congress said, listen, guys, and this is in 1930, you need to have a real economic loss, right? You can't just have a pretend loss. If I buy and sell a stock within a minute and have like $100,000 loss on the sale and then buy it back, right, I don't have an economic loss. And that's what this rule is meant to do. And that's what you really have to be aware of when you're trying to utilize this rule. Now, the wash rule only applies to securities such as stocks and bonds. And we're going to talk about crypto later, so don't be too nervous because it's not that much different than the rules as they apply to stocks and bonds. Now, as year-end approaches, a lot of people are going to be selling stocks because the stock market declined a lot and they want to utilize that losses. Now, let's say you sold a stock in January and you had a $100,000 gain, okay? And now in November, December, the end of the year, the market's crashed. Now, you don't want to pay tax on that $100,000 gain because the tax, if it's a short-term capital gain between federal and state, you could be looking at 30-40%. $40,000 is a lot of money. Or if it's a $10 million sale, okay, that's $4 million. So this is an important rule to understand. And in addition to that, you can also, if you do it right, and the IRS lets you recognize that loss, you can offset the whole gain on that $100,000 sale and then deduct additional $3,000 against your ordinary income and carry it forward into the future, that loss. So you need to understand the pitfalls and make sure you avoid the wash sale rules regarding these losses. Now, the wash rule states that investor must wait 31 days before rebuying the same security. If you sell a security and want to recognize the loss, it had to be purchased more than 30 days ago. So you have to be aware. If you bought, like, let's say, Facebook in November, and you sell it and buy it within, let's say you sell it 15 days later and you buy it again, you're not going to be able to deduct that loss. You need to wait 31 days before you buy it. So let's assume you want to keep the stock or bond in your portfolio, but want to utilize the loss to offset the gains. For example, let's say Facebook, you feel confident it's going to go up, but you want to recognize the loss, so you could sell it after you've owned it for 31 days and have, let's say, a $100,000 loss on that sale, and you're worried about, hey, it could go up in the interim, and you'd miss on the upside, if you thought it was going to go up a lot during that 30-day period, and this does happen a lot. So there's several planning tools you can use to harvest those losses without triggering the wash sale rule. You can sell the stock or bond and rebuy the same stock or bond after 30 days, right? That's no problem. Just make sure you mark it on your calendar. But you can also, let's say you have 1,000 shares of Facebook, you can buy another 1,000 shares of Facebook. And then after 31 days, you can sell 1,000. You'll be able to recognize the loss. You still have the other 1,000 shares, so if it did appreciate, you won't be losing it. So that's going to help somewhat. And then also, you can sell a stock or buy a similar investment. Now, this is one that I like people to do because, for example, if you sell Amazon, you can buy an ETF that has a major position in Amazon or something that does a lot of high tech, and that high tech ETF will participate in any upside. So you won't be, you could sell Amazon and not worry about losing the upside because you have an ETF or a similar type stock. Like if you sell Ford, maybe you can, maybe GM or Ford and Tesla if you think it's more, if it's a EV play. But you could try to find a stock that's very similar to that stock. If you want to sell Merck because you have a loss in it and buy another pharmaceutical company, this works great. So just be aware, there's things you can do. You can recognize the loss and you can participate in any upside. Now, if you're a little bit more sophisticated and you want to get involved in calls and options. You could sell a stock and buy the call option. The next day, buy the stock and sell a call option. In this way, you'll be able to recognize the loss, but you'll still have the stock. Now, this meets the economic, rules set by Congress, because you still do have you still have an economic where you could suffer a loss. The only thing you got to remember is that if you do this call and buy, the options, you have to remember that, every single stock is identified by what's called a QSIP number. And if you do this within the same brokerage account, let's say you have a bank at, Robinhood, and you do this technique where you're buying and selling a call and selling and buying a call, and you do it in the same account, they don't have the sophistication to realize that this is a different transaction, and they will disallow the brokerage firm will tell the IRS that you have a wash sale, and they won't let you deduct the loss. So if you're going to do this technique, you have to have two accounts. Okay, you may want to have an account at Wells Fargo or wherever, and then at Robinhood, and do half of the transaction in Robinhood, half in Wells Fargo, because then the QSIP numbers won't match up. And remember, this is a legitimate transaction, and you can utilize the loss. It's just that brokerage firms don't understand how the QSIP numbers work. So just be aware of that. If you're going to do it, you may want to have two accounts to do that. What about cryptocurrency? Okay. Crypto had a very tough year. I think Bitcoin this year went from like 60,000 to 16,000 or something like that. So there's tremendous losses there, and people are like, well, I got to watch out for the wash sale. I don't want you, because I think it's going to go back up. Let's say you think Bitcoin's going to go back up to $60,000. So you don't want to sell it and not participate in that. You can do some of the other techniques we talked about, because the rules are the same. The thing about cryptocurrency is not a stock or a bond. It's considered property. Now, as property, common law applies to the sale of cryptocurrency. Thankfully, the laws are essentially identical to the IRS wash sales for stocks and bonds, so I don't really have to go into in detail. So in a nutshell, you can offset crypto losses against other investment losses in stocks or bonds, and vice versa. So, again, talk to your, tax advisor. This is just something that I think is pretty important for people to understand, because this can be the difference between, saving 10 to 15% of your total income if you handle this loss transaction right, especially when we have devastation in a market like we have this year. You pay taxes when you have gains. When you got a year like this, you got to be ready for this year-end sale to make sure you handle it right. Okay, guys, so if you have any questions, leave it below, and one of my associates or I we answer every single question, you guys. And like I said, if you could smash the like button, I really would appreciate it. Thank you.